Hello friends, in the series on the income tax cases, today we will discuss a very important issue on the cost of improvement. Whenever the assessee incurs some cost of improvement, the department is very reluctant to accept that cost of improvement. In some cases, the assessing officer refers to the department valuation officer even without considering that the assessee has maintained the books of accounts and the assessee has incurred all the expenses for the purpose of cost of improvement, and those expenses have been incorporated into the books of accounts. So, what is the mannerism for referring the matter to the department valuation officer in case the assessing officer is not satisfied with the cost of improvement given by the assessee? This issue has been taken by Honorable Delhi ITAT A bench in the case of Brahmaputra Infrastructure Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 109 ITR Tribunal at page number 554. The case has been decided on 31st May 2023. In the present case, the assessee has incurred some cost of improvement. The assessing officer was not satisfied, and without rejecting the books of accounts of the assessee, the assessing officer referred the matter to the department valuation officer, and whatever the value was given by the D.V.O, that has been taken by the assessing officer for calculating the capital gain of the assessee. The assessee was relying on the case of Honorable Supreme Court in the case of Sargam Cinema versus Commissioner of Income Tax 2010, which has been reported in 328 ITR page number 513, in which the Supreme Court held that without rejecting the books of accounts, the assessing officer cannot refer the matter to the D.V.O. One thing is important, that if the assessee is eligible for maintaining the books of accounts or the assessee is maintaining the books of accounts, only then this rule will be applicable. For example, if an assessee is doing only some job and he is selling some property, then in that case he is not maintaining any books of accounts. So in that case, the question of rejecting the books of accounts does not arise. So the tribunal said that since the assessing officer has not rejected the books of accounts and has directly jumped to the option of D.V.O, that is not justified. Another issue was that in the present case, the assessing officer has made addition on the basis of some purchases by treating them non-genuine. For the genuinity of the purchases, the assessee has submitted the taxpayer identification number confirmation, which was signed by the assessee, although it was not signed by the vendor. The assessee has submitted bank statements. The assessee has submitted the invoices of purchases, and in addition to that, the assessee has also submitted the proof of payments in the subsequent years. But the learned assessing officer, just on the limited issue that the assessee has not submitted the PAN number, the assessee has not submitted the countersigned copy of the confirmation by the vendor, and since the assessee has not submitted the income tax return of the vendors, on that basis the assessing officer made the addition. It was also the allegation of the assessing officer that on some expenses the assessee has not deducted the TDS, so those expenses are non-genuine. When this matter came to the tribunal said that the reason that the assessee has not deducted the TDS cannot be taken as a ground to treat the expenses or the purchases as non-genuine. The tribunal said that it is not in the hand of the assessee to get the income tax return filed of the vendors, but if the assessee has submitted the other evidences, those evidences cannot be brushed aside, and the additions cannot be made only because of the reasons that the assessee has not submitted the confirmations which are countersigned by the vendors, because it is not in the hands of the assessee that he may get this copy signed by the vendors at the time of assessment. It may be that he may get those confirmations countersigned. But if the assessee is submitting all other evidences which are sufficient to prove the transaction, in that cases, on the just basis that the confirmed copy of the vendor, that is countersigned by the vendor, is not submitted, the additions cannot be made. In this case, some additions were made on the basis of some loose papers on which some amounts were written opposite to the names of some persons. For that, it was the viewpoint of the assessee, it was the submission of the assessee, that since it was not even mentioned in those loose papers that whether the assessee has received some payment or has made some payments, so in that circumstances, these loose papers do not have any value other than dumb documents, and these loose papers are for the internal purposes of the assessee, which are which have been written by the employees of the assessee just for their day-to-day purposes. So in that case, those loose papers cannot be treated as an evidence for making the additions. At the end of this video, once again I am repeating the name of the case. The name of the case is Brahmaputra Infrastructure Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 109 ITR Tribunal at page number 554. The matter has been decided by Delhi ITAT A bench, and the date of the judgment is 31st May 2023. Thank you, friends.